Hi, I'm Mike Sibley, leader of the James Moore Manufacturing team. On this episode of More on Manufacturing, we're going to do a little different presentation than we normally do. I'm going to go over some year-end roundup of financial reporting and tax considerations, just some things as we're getting ready to approach the end of the year. We've got about a month left until we hit the end of the year. And these are some things to be thinking about, some new things coming out this year that could impact you, and some things to even be thinking about for 2023 as you're getting ready to move into a whole new year. It's hard to believe that here we are, but we are, and this is the time that I usually start getting some different questions about preparing for year end. So I thought it'd be good to end with some of the common questions that I usually get. So let's just jump into it and start talking about some things that may affect you this year. So the first thing I'm going to hit on is financial reporting. Now, many of you have to have financial statements that you submit to the bank for whether they're compiled, reviewed, or audited. Maybe some of you only have to hand in tax returns, and this really won't have a really big impact. But there is a new standard coming out that affects what your financial statements may look like, and that's these new lease standards. And basically, what this really means is for companies that have leases, say you're leasing your building, you're renting out, say you have substantial equipment that you rent, things that you're just paying on a monthly basis that might last 2-3 years. Maybe with a building, it could be 10, 15, 20 years. In the past, all those were just treated as straight expense, no impact on your balance sheet unless you had a capital lease. These types of leases specifically that I'm referring to are called operating leases. Well, the financial reporting standards changed, and this year, starting with 2022, 12/31/2022, operating type leases along with capital leases will now be reported as an asset and a liability on your financial statements. So this could have a big impact on your liabilities, your current liabilities, and banks may or may not realize that this is going to be coming through, and your liabilities could potentially go up if you're leasing, particularly with buildings, because you could have a long-term lease that has a big liability still outstanding. Now, why is this going to be impactful? Well, a lot of times banks have what's called debt covenants. And debt covenants can have things like working capital requirements. They can have debt to equity or debt to EBITDA requirements in their calculations. And it's possible that when you add in these liabilities that were never there before, but yet you were paying these bills, you're paying these lease bills, that now all of a sudden they could throw you out of compliance with your covenants. And so it's a good idea that if you do have to report your financial statements to your bank, that you're having a conversation now. If you have outstanding leases, if you have operating leases, again, such as a building, substantial equipment, things like that, that could have an impact. I know I've talked to some banks, and they're going to evaluate it on a case-by-case basis, because a lot of times these debt covenants were written pre the lease standards or without the lease standards in mind. And so it's something that's going to be a pretty significant change. That's something you should be talking to if you haven't started talking to your accountant yet. I know a lot of accounting firms are starting to work on these calculations. They're relatively complicated. But again, if you do lease, whether it's a building or equipment, and you do turn financial statements into your bank, this is something that you're going to want to be thinking about now and having a conversation, so that way you can evaluate the impact. It's possible you may not even have debt covenants, or you may not have debt covenants that are impacted by it. But it's a good reason to get with your CPA now and figure that out before you get to the end of the year, just so you have a good idea on that. So that's really it on the financial reporting side of things. I'm going to jump into the tax side of things now, with first hitting the Inflation Reduction Act. Now, for the most part, a lot of companies under $1 billion are not going to be impacted by this. It was really the main part of this was impacting companies that had over $1 billion, and they were really trying to get companies who were very, very large, showed substantial financial statement income, yet had little to no taxable income. So there was a calculation that goes back in taxes based on financial statement income. But again, this is for very, very large companies. But there are a few pieces that may impact smaller companies. For example, there was some changes. This already existed, 179D, but for when you're putting in energy efficiency improvements into commercial buildings, there are some benefits to enhancing deductions. Now, as you know, there's bonus depreciation, there's 179 expense. A lot of you are familiar with those terminology, but there is an energy efficiency component to that. Again, this is something you should discuss with your CPA if you've done substantial improvements to your building. On the other hand, there's been this isn't new, but for a long time, there's been the ability to do what's called cost segregation. This is where if you, again, have done substantial improvements or you're building a building or you've recently purchased one, where you can actually componentize certain pieces of the building rather than depreciate it over 39 years, you might be able to speed up that depreciation and perhaps even take bonus or 179 depending on how that is broken out. So again, anytime you're doing something substantial with a building or to a building, it's worth having a conversation to see if some of that allows you to depreciate even faster. There's also, as part of the Inflation Reduction Act, a new component called this Advanced Manufacturing Production Credit. And this new production credit is eligible for solar energy if you're producing components that relate to solar energy, wind energy, inverters, battery components, qualifying battery components, and other areas of solar energy or alternative energies, I should say, in the United States. There's some credits that can be pretty substantial to that. So it's thinking about components that go into alternative energies. So if you're involved in anything like that, that may be something to start looking at. It doesn't really apply until 2023. So it's time to start planning and thinking about that sooner rather than later. There's also a production of clean hydrogen component as well. Again, that's for hydrogen produced after 2022. Not sure a lot of companies are involved in that. But certainly with the advanced manufacturing production credit for components related to alternative energies, it's potential to see a lot more companies involved in those kind of things. So those are just a few pieces of the Inflation Reduction Act that may or may not have an impact on you coming up, but particularly you may have some for 2023. Aside from that, there is also a change in the R&D credit and how that's not so much the credit, but R&D expenses. Several years ago, when the 2018 tax law changed, there was some change in the R&D credit. And basically, R&D expenses for 2022 going forward are now required to be, for tax purposes, capitalized and then amortized over 5 years. So when we talk about capital, let's just say you have $100,000 of R&D expenses. Basically, what that means is you have to put it on your balance sheet for tax purposes and amortize that over 5 years. So you're not getting the full deduction for it. There's still credit available. You can still get the R&D credit, but this is going to have a little bit of an impact on those R&D expenses and the calculation. Certainly, if you've got significant R&D expenses or you're starting to accumulate quite a bit of R&D expenses, you need to be looking at the R&D credit. A lot of times manufacturers don't realize that things like prototyping, product development, process improvement, enhancements, things of that nature can qualify. And it's there's a labor component, there could be materials and supplies that go into those things. So there's a lot of components to that. And so certainly if you're not thinking about the R&D credit and you're doing some of those things, it's worth having a conversation about. But the R&D expenses are going to be treated differently for tax purposes now and being amortized over 5 years. There's some out there who believe that this is, there seems to be some support in Congress for removing this change, removing this requirement. However, nothing has happened on that as of yet. So we'll have to keep an eye and see if it does change. But for now, At this point, we're moving forward assuming that we're going to have to start capitalizing those. And of course, from a tax planning standpoint, if you have substantial R&D credit, R&D expenses, that could have an impact on your tax planning implications. And again, that's something we want to start thinking about sooner rather than later, so you're not having huge surprises come April 15th or March 15th, when your taxable income is being determined. So let's talk about now some typical reminders that we have. Again, this is where I get a lot of questions every year. Hey, what can we do? And then when we're going through the tax planning process with clients, these are some of the things that we're talking about. So the first thing we're going to talk about is equipment purchases. We get down to the point of people are trying to say, hey, I've had a lot of income this year. Should I buy some equipment? My first response is, if you're going to buy it anyway, then go ahead and do that. It's a good time. Just get it in service before the end of the year so we can take advantage of bonus depreciation. The key thing is that it does have to be in service. Alternatively, you never spend $1 to save 30 cents or 37 cents or whatever your marginal tax rate might be. If you don't need the piece of equipment, or you're just buying something just to get a tax deduction, I'd rather you keep the other 70 cents and have all of that cash at least. But again, if it's something you need, if it's something that you're really is going to help your manufacturing process facility, you need it to increase production, whatever it might be, then I think that's a good idea. Now, vehicles. This is one of the other questions we get a lot of. Vehicles, they have special depreciation rules. Usually large vehicles over 6,000 pounds, you can take immediate deductions, but vehicles under that, particularly if you get cars and small SUVs and things like that, a lot of times there's very limited depreciation that can be taken, and it gets taken over time. And on top of that, you often have with those kind of vehicles a lot of personal use, and the personal use generally needs to be accounted for as wages or non-deductible expenses. So there's a lot of limitations when you get into vehicles, and there's a lot of things to be careful about. So anytime you're looking at purchasing a vehicle to get a tax deduction, that's something I think you should talk to your CPA about, and make sure that you're making the best decisions for what's really going to be a good bang for your buck, what's really going to save you money, and what's going to save those taxes, again, based on things that you really need for your business. I mentioned this before, but making substantial improvements to your building, or if you've built a building and it's in service now, added substantial energy efficient components to your building, things like that. Again, that's something that we may be able to have some cost segregation studies done, and some look at how can we speed up any of those improvements to get deductions now. Now, depreciation, of course, is a time value of money thing. With depreciation, you're going to get your deduction. It's just a matter of whether it takes a little longer to get it, or you can speed it up. Oftentimes, obviously, we like to speed it up, get our money now, and we at least have the use of those tax savings now. I know there's a lot of different philosophies on that. Some people don't like to take the bonus because it makes their income kind of herky-jerky, goes up and down. And generally speaking, we try to, as much as possible, take those deductions when we can, because you never know what's going to happen in the future in terms of, whether we're talking about recessions or, other equipment purchases, especially if you're a company that continues to have a lot of CapEx each year, just because of the nature of your business, or you're replacing a lot of machinery and equipment over a period of a few years. Taking that, you can almost get a few years of a good cycle of depreciation going there. Particularly while I know a lot of companies have been very successful over the last couple of years and have some good backlog going into 2023. So again, those are things to consider when you're looking at depreciation. Next one is cash basis versus accrual basis. A few years ago with the 2018 tax law, a lot of manufacturers for the first time could actually convert to cash basis. Now this makes sense sometimes, particularly if your receivables and prepaids are substantially more than your payables and your accrued liabilities. There's some potential to defer that income using cash basis methodologies. That's not right for every business, not right for every manufacturer. It's something that you have to go through. Uh, and for manufacturers on a cash basis, generally they're accrual basis. So oftentimes things that you can do to make sure that you're uh, you know, maximizing on an accrual basis, you can certainly delay shipments at the end of the year. Delay those shipments because on an accrual basis, you report income when it's shipped, when you record those receivables, basically. So that brings up another component is making sure you get a good cutoff. On an accrual basis, make sure you get everything booked properly. Make sure you get all your payables in. Oftentimes, what I see is when you get into January and beyond and late January, invoices that come in that relate back to the previous year just get put into that new year. So 2022 invoices that come in 2023, oftentimes I see them in 2023. Put them back in 2022 to make sure you're getting maximizing the expenses that need to go into your financials so you can get those deductions. Again, under accrual basis, that's a good strategy to make sure everything is in there. Under cash basis, what you want to do is make sure that it's more about collections. What have you collected this period of time? And what have you paid out? So oftentimes you can control those payables by paying things in advance or paying bills. Let's just say you were going to pay bills the first week of January, the second week of January, and you've got the cash on hand. You can make those cash payments and still get that deduction now. Under a cash basis, if you wait to make the payment even a few days into January, you're going to defer that deduction for a whole year. Likewise, you can use lines of credit and to get enough cash so you can make those payable payments, or you can even use credit cards to make those payments. Credit cards under cash basis are still deductible. So those are some various things you can think about as you're getting prepared for the end of the year, whether you're cash basis or accrual basis. The next area, and this is particularly for, both actually, but cash and accrual basis, because for a manufacturer under cash basis, you can still have inventory on your books. So make sure you're really evaluating your inventory. You don't get a deduction for inventory until you actually write it off, until you dispose of that inventory. So if you've got obsolete inventory, one has carrying costs that come with it. So if you have a section of inventory that's old and obsolete, people are moving it, people are managing it. It probably gets counted when you're doing your year-end inventory or your cycle counts, things of that nature. So time is actually still kind of accruing to that. It takes up space. So if you've got old or obsolete inventory, dispose of it, fire sale, whatever you need to do that gets it out of your inventory, and then you can take a deduction for it. There's no sense in if you're carrying that old inventory on your books, it's not doing you any good. It's costing you money. Get it off the books. Similar to that, we have accounts receivable. On an accrual basis, you recognize your receivables as income when you ship those items. So if you've got receivables on your books that are old, they're not collectible, you're just carrying them, you haven't cleaned up that list in a while, go through that list, write them off, make sure they're written off so that way you don't pick it up as income. So if you sold something in June of 2022 and it's still a receivable as of December of 2022, maybe that company's gone out of business. For whatever reason, they're disputing it and you're never going to collect on that. Write it off, get the deduction for it, or in other words, not pick up the income for it. And that makes it a little bit, so you're not paying tax on something that you haven't collected or won't collect is the bottom line there. Another area is year-end bonuses. Year-end bonuses are fine. If you're on accrual basis, year-end bonuses, you can accrue all but the shareholders. You can't, if you accrue shareholders, it's not going to be a deduction. Shareholders don't get that benefit. But you do have to pay it, but for everyone else, you do have to pay it within 3.5 months. The same with vacation and things like that. If you're cash basis, those year-end bonuses need to be paid out before the end of the year. So there's some differences you need to think about going back to the cash versus accrual basis. That will make a difference for you. So there's different strategies you can use to look at preparing for year end. Another area is, do you have a retirement plan? There's all sorts of retirement plan options out there, especially if you're a company that produces a lot of cash and has a lot of cash availability. You can look at profit sharing plans. There's also cash balance plans. There's different types of matches. that you have to really get with your third-party administrator and your CPA, because there's a balance between what you need to make sure that you're not discriminating against your employees versus what can go to yourself as a shareholder. But with these cash balance plans, there's a potential to put more away for you and your family and get a big tax deduction, potential big tax deduction. But again, you have to look at, does it make sense with how much you have to make sure you're providing for the employees as well. So there's some calculations that go through for a cost benefit standpoint that could make sense for you. Another area that often comes up is, what should the owner's salary be? Sometimes we see salaries that are just way too high, which hurts you because there's another qualified business income deduction that you get on your, especially if you're a pass-through entity, an S corp or partnership. Usually it's S corps we see. That actually gets reduced if you're taking out too large of a salary. Your salary needs to be considered reasonable under IRS rules, and so you need to determine what reasonable is and not pay substantially more than that, because it's hurting your ability to get some of this QBI deduction, as we refer to it. Again, this is something that there's not great definitions out there for reasonable salaries. There's ways to look into it and come up with a good number on that. But that's something to also think about, talk with your CPA and see if you can't come up with something that you're comfortable with and reasonable. As always, there's a lot of different nuances to each business, to how you run your business, to how you're managing expenses, cash versus accrual, tax basis versus financial statement basis of accounting. So there's a lot of different things that can come into play that I've not touched on here. So that's something that, again, I would encourage you to contact your CPA and have those discussions now, so you can start planning. There's still some time to get some things done before the end of the year, and hopefully that hopefully this gives you the ability to kind of think about some things differently. And with that, again, I encourage you to reach out to your CPA, reach out to us, reach out to me to ask any questions. We'd be happy to talk through anything with you. And with that, I hope you have a great rest of your day.
To learn more about James Moore & Company's manufacturing services, go to jmco.com. And don't forget to subscribe to our More on Manufacturing series to receive updates when new videos and podcasts are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us on our website. You can also follow us on social media for more news as the landscape on manufacturing continues to rapidly evolve.